You've been waiting for interest rates to drop so you can finally buy a house. I have something that will help you even more.
When you account for U.S. incomes, U.S. home prices, and mortgage rates, we're at a 40-year low for affordability.
Because I've created a strategy for you to still get a 3% mortgage rate in 2025 without waiting for interest rates to drop. Let me explain. We've been seeing mortgage rates hover around 7% for the last couple years. The average $500,000 home would cost around $4,500 a month with a 7% mortgage rate, including the taxes, insurance, and other fees. However, you could rent that same home for $3,500 a month, sometimes even less. What if you could save $1,000 a month? Then you would be able to buy a house for the same price you can rent one. If you look at this chart, you're gonna see mortgage rates are at the same level as 2008. So just like before, they're gonna come down eventually. But if you wait for that to happen, you're gonna miss your chance at buying a cheap house. But now that you're an expert on why mortgages matter so much, it's time to save you a lot of money. I'm gonna show you the 3 ways you can still get a 3% mortgage. Then I'm gonna show you the best kept secret in real estate today. But let's start with the first way to still get a 3% rate, the assumable mortgage. Since the banks won't give you a 3% rate anymore, the other option is taking over someone else's loan. When you assume a seller's mortgage, you get their entire loan, including their incredibly low 2.5% or 3% interest rate. This is because when they bought their house back in 2020 or 2021, that's what the interest rates were going for. Or they might have been smart and refinanced. But you can't do this on every loan. However, by law, most government-backed loans like FHA and VA are assumable. All you have to do is qualify with the lender. I actually did this last month with a client which brought their rate down from 6.8% all the way down to 2.7%. I'll show you in a second how much that saved them. It was a lot. This is one of the biggest kept secrets in real estate, but there's one even better. The next way to still get a 3% interest rate, subject to financing. Let me explain what this means and how to do it, because it's similar to an assumable mortgage, but there's a twist. Subject to is where you agree to make the payments on the seller's mortgage, but the loan stays in their name. This is really cool because the deed of the house goes in your name, but the mortgage stays in theirs. This way, if they got, let's say, a 2.9% rate back in 2021, they are paying much less per month on the house. So on a $500,000 home, you would pay under $3,000 a month. However, there's a catch. For example, if you miss too many payments, the deed gets transferred back into the seller's name. So let's say you had been paying off the house for a couple years at this incredible 2.9% rate, but all of a sudden you can't make the payments anymore. The deed would go back in the seller's name and you'd lose the house. Keep in mind, if you don't want to try any of these, I still have a really cool trick for you to save 1 or 2% on a loan, which I'm going to show you right after this. The third way to get a 3% mortgage is seller financing. This only works when the seller owns the home outright. If you're wondering how many homeowners don't have a mortgage, it's a lot. Over 30 million Americans don't owe anything on their house, which is up 40% in the last 15 years. So this could be a really good option if you find the right seller. How this works. Instead of you getting a loan from the bank, the seller becomes the bank. You pay the seller every month instead of the bank. You might be wondering, why would they do this? Well, if nobody is offering the price that they want, they can use this to get it. Let me give you an example. I just had a landlord that wanted out of their house. They bought it as an investment property, but didn't realize all the headaches having a tenant would cause. So they let me offer seller financing to a buyer, and they gave a 3% interest rate. In this case, everybody won. The seller got the higher price that they wanted, and the buyer got a much lower monthly payment. So those are 3 really cool strategies to still get a 3% loan in today's market. But what if the seller's loan isn't assumable, or they don't own the house outright? That's why I want to show you how you can still save 1 or 2% on a loan today from the bank. It's getting the seller to buy down your interest rate. Let me explain, because it's very simple when you hear how this works. Remember in my last video how we got the seller to give a $30,000 credit? You can do the exact same thing, but for your mortgage. So what you want to do is ask the seller for a credit at closing that goes directly to the bank to lower your interest rate. This makes a huge difference. For every 1% your mortgage rate drops, you save hundreds of dollars a month. This could be the difference between being able to afford the home and not. Now, there's two really good options that you can pick. The first is a permanent buy down, which lasts for the entire 30-year loan. But I have something even better than that, which is by far my favorite trick in real estate right now. I personally do not like the permanent buy down because mortgage rates are gonna come down eventually. That's why I highly recommend going with option number 2, 3-2-1 buy down. This is where you use the seller's credit to drop your rate for the first 3 years. Look at how much this reduces your interest rate. In year 1, your interest rate is 3% lower. In year 2, it's 2% lower. Year 3, it's 1% lower. Then in year 4 and beyond, it goes back to the full rate. Now I know that might not sound like a lot, but let me break down how much money this is actually going to save you on a $500,000 home. At today's 7% interest rate, your normal mortgage payment would be about $2,700 a month, not including any taxes or insurance. But with a 3-2-1 buy down, in year 1, since your interest rate is now 4%, your monthly payment drops to $1,900. That's a savings of $800 a month. In year 2, your rate goes to 5%. So your payment is $2,100, which is still saving you $600 a month. And in year 3, your rate is 6%. So your payment is $2,400, which still saves $300 a month. In year 4 and beyond, it does go back to $2,700. But don't worry about that, because remember what I said before about the banks eventually lowering the mortgage rates. In 4 years, I can guarantee you interest rates are going to be significantly lower than they are today. So all you have to do is refinance your loan in 4 years. That is why this is the best strategy in real estate today. You get the best of both worlds. However, there's one more trick that I'm dying to show you, but that's gonna have to be for my next video. So don't forget to subscribe. Until then, check out this video above.